Scalping is overcomplicated by many, and that's why you get confused and lose trades like this, when in reality it should be simple to understand. And we're going to implement the complex concepts only to find high-quality setups, so pay close attention and let's get started. For the first step, we identify the first 15 minutes candle that opens the US session. It should be around 9:30 a.m. Eastern Time, and we wait for the candle to close at 9:45, so 15 minutes later. Now when the candle has closed, we move into the second step, and that is to draw the high and the low of the recently closed candle. So far it's super simple to understand, and that was the second step. Now into the third step, because here it gets more complex. So after drawing the high and low, we switch into the 1-minute time frame. And in this 1-minute time frame, we're going to look for the market to break above the range high or below the range low. We do not trade while the price is moving inside this range. It is really important to wait for the breakout. I tell you that because some traders try to predict the direction of the break, and I'll tell you a tip later on how you can increase the chances of knowing in which direction the break might happen. However, keep in mind that it is not for sure, but just a probability increase. So very important for almost any trader to first wait for the breakout. Now there are two scenarios. If it breaks the range high, we move into the next step, and that is waiting for the price to pull back into the range high that it just broke recently. If this happens, and it often does happen, we wait for the first bullish reaction from this pullback. Basically, we look towards the pullback ending with a large bullish candle that preferably breaks and closes above the previous candles, and that is when we're going to place a buy position right away when that candle closes. So basically, the order should fill at the next candle open, usually with the stop loss below the recent lows, and the take profit in such a way to adjust a 1-to-2 or 1-to-3 risk-reward ratio. But the market also has the possibility of breaking down below the range low. In this case, we will wait for the price to pull back into the range low that it just broke, and on the retest of the zone, we will be looking for a large bearish candle to form, preferably a candle that closes below the previous candles. The candle closure is important because it confirms that sellers managed to push the price down, but also to keep it there. Unlike if there would be a large wick that moved down below the previous candles, but without closing below, and instead the wick showing that sellers pushed the market lower initially, but didn't have enough strength to hold the bearish pressure. So back to the main point. Once we get the bearish candle close, we can now enter with a sell short position on the candle closure, position that will be opened on the open of the next candle, with the stop loss placement above the recent highs, and the take profit adjusted in such a way to have a 1-to-2 or 1-to-3 risk reward. This is the Nasdaq. I found this works best on indices, but it can work just as well on all markets, especially if you've been trading the same pair for a while. Now that we've identified the first 15 minutes candle that opened the US session, we mark the high and the low, and now we're going to move into the 1-minute chart. Here we see the range high, the range low, and between the two, we have the price action inside the range, which is the move that we don't need to give too much importance right now. We will do, but after the first range breaks. We're slowly moving down, approaching the range low. Range that breaks later on. A break is valid only if we have a candle closure below, and we have that here. Now we can also apply some simple market structure concepts. For example, in this market right before the break, we see a formation of a downtrend, basically constant lower highs, with constant lower lows. In other words, we expect that the previous lower high should not break, and the previous lower low to break down into a new one, which would form a break of structure, basically just a continuation of what has already happened. Now the first larger bearish candle from the recent move just formed, so this candle could be used as an entry, with the stop loss above the past lower high, because keep in mind that after the break of structure, we validated a new lower high. So basically this lower high has held, and now we formed another one, that we hope it will hold as well, because that will avoid a stop loss, and the take profit in such a way to target 1-to-2, or a 1-to-3 risk reward. Because we don't have a lot of price data from the left, I'll go for here. It's best to not be too greedy. And now we basically just wait, because the order has filled, closing with a win shortly after. But almost getting stopped out. See, that is why I focus a lot on market structure concepts, because once you are properly able to apply them, you will notice that you'll probably lose far less trades just because your stop loss and take profit targets are placed with a logic. Into another example. Here on the 15 minutes chart we can see a very clear uptrend, so if the initial trend was bullish, there are higher chances for the 15 minutes candle to break the range high. So we first mark the high and the low of the candle. Then we move into the 1-minute chart. From this move that formed from the range low into the range high, we see an uptrend, basically a constant formation of a higher high with a higher low, just for later to break the range high, with multiple candles closing above the range. And so far it's looking like it's consolidating. A consolidation is a preparation phase. And finally we got the retest of the broken range high, with the price instantly rejecting back to the upside after wicking down into the range. So we can look for a buy position on this candle closure, with the stop loss below the recent low, and take profit above the local high, which is a 1-to-2 ratio. Now we just have patience. Bullish momentum is starting to appear, and it's slowly getting closer into the take profit, closing the position on the take profit. Now on the SPY, we see a market that is obviously downtrending, which by the way, just because the initial trend was bearish, the market has a higher probability of breaking the range low. So we mark the high and the low, and now we move into the 1-minute chart. The current price being so close to break the range low, it's going to do, and yes it did, with multiple candle closures below the range. Now applying the advanced market structure concepts. Knowing we're in a downtrend, we look for supply zones and resistances. One that is easy to observe would be this one, but it is too far from the current price, actually being on the range high. Even if it is a valid zone, it doesn't fit with this strategy. There is another supply below, actually the last one on this entire price action, so if the market would reject from a zone, it has a high probability of doing it from here. And if we think that, we can now feel free to sell short down from this zone, with the stop loss above this zone, which is right about the past lower high, and for the take profit should be around 1-to-2, 1-to-3, depends on what structures the market will form, but wouldn't go above 1-to-3 anyway. So we've got a continuation to the downside, then the market started pulling back up, retesting the recently broken range low. If you're more careful, you should also pay attention to how the price formed this move. It formed with an uptrend structure of multiple higher highs and higher lows, which eventually hit the supply and fill the order right here. Now the question is, where would we look for the take profit level? Well, if we sell short, it's because we expect a downtrend in the near future, and if we enter into a downtrend, that means that we're reversing the structures of higher highs and higher lows to lower highs and lower lows. A logic placement for the take profit would be below a previous low, since we're expecting a lower low. And this being the first level, however, the risk-reward might not be enough. I would target the second one. This respects the 1-to-2 ratio, which is enough. So far, it's moving in our advantage. And there you go. Take profit, hit a couple candles later. Now this time let's try on the gold market. By looking at the external price action, we're seeing higher highs followed with higher lows, this happening multiple times. So a clear uptrend has happened, up until the price aggressively pushed downwards, and this downside move breaks below the previous higher low. So this marks a market structure shift, basically a first important clue that we're reversing from an uptrend into a downtrend, just for later for the market to push to the upside, but looking like it's about to form a local high, which would be lower than the previous high, setting a lower high. Now if we want to know if this move will respect and move to the downside, or break to the upside, since we are bearish biased because of the trend shift, we look if there is a resistance or supply near the past highs, and there is one right here, and the price actually has hit that level and rejected back down with a very bearish candle coming after. This bearish candle indicates that this zone might respect, and that would drag the market down into a swing lower low. Also, that bearish candle has opened and closed the first 15 minutes of the US session. So we mark the high of the candle and the low of the candle. Now we switch into the 1-minute chart. Here we've got a break below the range, however it was done with a wick, without a candle closure. So far it's not a valid move, so we must wait for longer. And it's now when we see the valid break, done with a candle closure below the range low. Now we identify a supply or resistance, which should be around here. Keep in mind the supply is the last bullish candle before the impulse to the downside. And the zone is taken from the whole candle, including its high wick and low wick. So now we can position the setup as it follows: stop loss above the zone, which also coincides being above the recent highs, and take profit below the lows. A 2.5 ratio is fine in this case. I would target for more, only if I would see more data from the left, which we don't have in this case. So instantly after the breakdown, the price pulled back up and filled the supply, moment where it also instantly rejected to the downside, moving into the take profit level very quick this time. Now keep in mind that this is an oversimplified way of trading, and it might be enough for many to start seeing some results, but there are a lot of ways to get the best quality setups. If you're interested in doing as best as you can,